This is Money and Metals for the week ending May 1st. The dollar touched a two-week high against the yen on Friday and rose from a two-month low versus a major basket of currencies. Can this be supported by signs that the U.S. economy may be stabilizing? U.S. economic reports on Friday showed some weakness noted in manufacturing and construction, but they did not stop investors from buying back what had been an oversold dollar. Basically, I look at this as a technical rally to the trend line, and I think the U.S. dollar may suffer some weakness not in the not-too-distant future. The euro was flat at 1.12 euros versus the dollar. The dollar rose against the yen. And the United Kingdom, the sterling fell sharply against the dollar and the euro after British manufacturing data showed growth cooling before a tightly fought election. Data show that U.S. manufacturing activity held near a two-year low in April. Yet we received reports that there was a jump in consumer sentiment due to stronger than expected vehicle sales. Again, question that data a bit. Separately, the Commerce Department said construction spending slipped about 0.6% to an annual rate of $966.6 billion, the lowest since September. The net effect was positive on the dollar, which is hard to believe. The U.S. currency started to gain momentum last Thursday as signs that the labor market was recovering from the initial jobless claims dropping and wages rising, along with a jump in Midwest business activity. Moving on to the gold market. Gold hit six-week lows on Friday in thin trade ahead of holiday weekend as the dollar strengthened on U.S. economic data that I just outlined. Technical factors were at play with downside momentum gathering pace as prices fell through the April low of the 1175 level. Gold hit its highest level since April at 1,215 earlier in the same week. However, it failed to hold that after the Federal Reserve signaled on Wednesday that what it sees may show a slowdown in the U.S. economy, and they're not ruling out an interest rate hike later in the year. Gold has traded in a narrow range the past month, and I expect to see that continue for some time. The metal is highly sensitive, in fact, more so than it should be, in my view, to this interest rate talk. Many European markets, with the exception of London, were closed on May Day as it is a holiday. Next, I'd like to speak about gold equities. Gold equities have improved much relative to the gold price itself and may have further to rally. Major gold miners have shown strength this year, with the Toronto Stock Exchange, the TSX Global Gold Index, gaining 14% this year alone. The TSX-based index group is the top gold miners on the planet, including number one Barrick Gold Corporation, up 20.5% this year, number two Newmont Mining, which has gained 40% this year, and number three Johannesburg-listed Anglo Gold Ashanti, which is up 32% this year. If you're not in the gold equity sector, some of these numbers will probably be surprising to you. However, gold equities are still vastly undervalued relative to spot gold because at the current price level, the gold equity index is underperforming the gold price by a margin of about 65%. History shows that gold equities outperformed spot gold for most of the time between 2002 and the global financial crisis of 2008. So what will it take for gold equities to reverse their underperformance relative to gold? Gold supply may be the key. The most obvious answer is that equities tend to outperform on a sustained basis when gold prices are rallying, but it may be possible for the shares to make gains even if the gold price remains largely steady. GFMS, Goldfield Mineral Service, expects gold mine supply to decline this year, again in 2016 and 2017. Gold equities may recover faster than the gold price, especially if there's a decline in mine supply, which would leave remaining companies better placed to take advantage of a tightening physical market. So in a nutshell, what I'm saying is the gold equities have outperformed the gold price. I think that trend may continue. And of course, the fundamentals about the amount of gold available over the next 3 years looks as if it's going to be rather short relative to what it's been. So as far as I'm concerned, this market has a long ways to go, and we may be still in the bottoming process. And moving on to the silver market, in this year's CPM report on silver, the report does take a little time to discuss the relevance of the gold-silver ratio. and concludes that the relevance is not particularly valuable. The so-called historic 16-to-1 ratio set by Sir Isaac Newton in the early 1700s, when silver was very much a monetary metal alongside gold, no longer has any importance according to CPM. CPM does note that it expects silver prices to consolidate during 2015 after ending 2014 at $15.60, down 19% for the year. It goes on to say that the decline in prices during 2014 was a continuation of a trend that has been in place since 2011. No surprises there. Silver prices declined primarily due to short-term investors or traders moving out of the silver market, the commodities market, and into the equity market. In its own brief release on the Silver Yearbook, CPM comments that investor demand plays a very important role in determining the direction of silver prices. On a net basis, it sees investment demand as having fallen to 131.6 million ounces in 2014, which is off about 12.5% from what it was in 2013, according to their analysis. 2014 and early 2015, sales by short-term investors have been offset by purchases by long-term investors, but according to CPM, it requires both short-term and long-term investors to come back into the market to significantly move the price higher. Global silver fabrication demand continued to rise last year to 865.3 million ounces, up 3.5% from what they stated for 2013. CPM also calculates that total refined silver supply rose to 996.9 million ounces in 2014, up 1% from 2013. The increase during 2014 was driven primarily by an increase in mine supply and secondary supply declining for the third consecutive year. Overall, CPM sees bullion supplies having exceeded demand by about 100 million ounces, and without significant mine closures, there is perhaps little reason to see changing the silver price much in 2015. CPM does not expect the Fed to raise interest rates before September and maybe even beyond that. And lastly, CPM says, given the relatively small size of the silver market, it will only take a few dollars to push the price higher. And more details on the CPM 2015 Silver Yearbook can be found at cpm-group.com, and you can purchase this report for further study. And that will conclude this week's report.